When it comes to investing that cash in the stock market, the choices can feel monumental, especially with the trillion-dollar titans. For many investors putting fresh capital to work, there's one burning question. Which company makes you richer 5 years from now? Apple or Microsoft? This isn't just a casual thought experiment. It's a decision that could genuinely impact your financial future. Before concluding they're both great and you should just own both, consider this. Since 2019, Microsoft has actually outperformed Apple's stock by a significant margin. Yet, despite that impressive performance, Apple is often traded at a lower P/E ratio. It's a head-scratcher. Why would the slower-growing company command a higher relative valuation? The answer isn't simple. By the end of this video, the curtain will be torn down on both, and you'll have a clear view of where the smart money is pointing next. This analysis isn't about gut feelings. It's about the numbers, the business models, and the future. If you find this kind of deep dive valuable, make sure to subscribe for more. Why these two still matter. Apple and Microsoft consistently rank among the most valuable companies on Earth. Together, they make up around 12.5% of the entire S&P 500 index. That means when either of these behemoths moves, your diversified index funds feel it. Your 401k, your IRA, your brokerage account, they are all impacted by this ongoing duel. What makes this fascinating is that their paths to profit look nothing alike. Understanding this difference is critical to choosing the right stock for growth. Apple primarily prints money by selling high-margin hardware. We're talking about phones, laptops, and tablets, but at luxury markups. It's a hardware fortress built on brand loyalty. Microsoft, on the other hand, is in the business of renting software and cloud services. It's a recurring revenue machine. This clash of philosophies, one physical, one digital, one transactional, one subscription-based, is the first step to understanding their future. Apple, the hardware fortress. Let's dive into Apple. In the third quarter of 2025, the company posted revenues of $94 billion. About 47% of that came from the iPhone. Now, critics often point to this as a single product risk. But Apple has two powerful advantages that turn this risk into a strategic strength. First, the gross margins on its hardware are higher than most luxury brands. They sell essential technology at premium prices, backed by masterful branding and supply chain management. This isn't a commodity product, it's a status symbol. Second, and more importantly, is the walled garden. Once you own an Apple device, you enter an ecosystem. Services like iCloud, the App Store, and Apple Music generate cash at over 70% margins with no extra factories needed. That services division brought in $27.4 billion in Q3 2025 alone, growing at a healthy 13% year over year. Apple is stealthily becoming a subscription company, yet the market often still values it like a cyclical hardware business, creating a potential opportunity. What's the bear case? Geopolitical tensions, tariffs, and supply chain risks, particularly with its manufacturing concentration in China, are persistent threats. Also, consumers are holding onto their phones longer, which can pressure hardware sales. But the bull case is powerful. A 2 billion device installed base provides a captive audience. The company has brand loyalty that borders on religion and a balance sheet so strong it could acquire major companies with pocket change. Apple is also mitigating supply chain risks by diversifying production to India and Vietnam and has pledged a massive $600 billion investment in U.S. manufacturing. Microsoft, the subscription empire. Now, let's pivot to Microsoft, where the magic word is recurrence. The business is built on the steady drumbeat of monthly and annual revenue from Office 365, Xbox Game Pass, and Azure Cloud Services. This isn't about one-time sales, it's about ongoing relationships. Their cloud business is the engine. In the fourth quarter of fiscal 2025, Microsoft Cloud revenue hit $46.7 billion, up 27% year over year. More importantly, the Azure Cloud Platform surpassed $75 billion in annual revenue, growing at a staggering 34%. While Apple is developing its AI strategy, Microsoft is already monetizing AI through tools like Copilot, which costs businesses up to $30 per user per month. In terms of profitability, Microsoft's net profit margin hovers around 36%, significantly higher than Apple's. Their debt is manageable, repayable with just a couple of years of free cash flow. Of course, risks exist. Competition in the cloud space from Amazon and Google is brutal, and a price war could slow growth. But Microsoft's secret weapon is stickiness. Once a company builds its infrastructure on Azure, the cost and disruption of migrating are immense. They are building an empire that's incredibly difficult to dislodge. Head-to-head numbers. Let's run the tape. Over the past decade, Microsoft's MSFT share price has delivered a phenomenal gain of over 900%. Apple, AAPL, also produced a fantastic return of nearly 800%. Both are incredible, but Microsoft has the edge over that longer horizon. For dividend yield, Microsoft comes in around 0.7%, while Apple sits near 0.45%. Neither is a true income play, but Microsoft has a slight lead. Now, valuation. This is where it gets tricky. Apple currently trades at about 35 times earnings, while Microsoft is closer to 37 times earnings. On the surface, Apple looks cheaper. But a crucial, often overlooked metric is the Sharpe ratio, which measures return per unit of risk. Here, the numbers tell a clear story. Over the last year, Microsoft's Sharpe ratio is approximately 0.7. Apple's is lower, around 0.2. On a risk-adjusted basis, Microsoft has rewarded shareholders more smoothly. You get more return for the volatility you endure. The AI catalyst. Artificial intelligence will define the next decade, and this is where the race gets decided. Apple's AI plan feels like it's in stealth mode. We hear of on-device processing and potential partnerships, but tangible revenue-generating AI products are still on the horizon. Microsoft's AI plan, however, is live and monetizing today. GitHub Copilot already has over 1 million paying developers. Azure OpenAI service is making cutting-edge AI models accessible to businesses of all sizes. Enterprise customers are now budgeting for AI spend even faster than for traditional hardware. In the short term, this means Microsoft's revenue is accelerating, fueled by tangible AI services. Apple's AI income is still largely categorized as future potential. The question isn't whether Apple can do AI, but if they can ship it fast enough to compete with Microsoft's massive head start. 1-year outlook. So, what does the next 12 to 18 months look like? Wall Street models project Microsoft's revenue to grow by 14% to 16%, driven by cloud and AI monetization. Apple, however, is forecast for mid-single-digit growth. This is due to iPhone upgrade fatigue and its vulnerability to geopolitical tensions with China. If a recession hits, consumer spending on hardware like new phones is typically the first thing to be cut. Enterprise software contracts, while not immune, are more resilient. For investors with a shorter time horizon, Microsoft appears to offer more predictable growth and less exposure to consumer spending fluctuations. 5-year outlook. Zooming out to 5 years, the stories for both companies remain compelling. Apple's services business could realistically double, creating a massive cash flow annuity attached to its loyal customer base. Meanwhile, Microsoft's cloud business could triple, with high operating margins. If you model these scenarios, both stocks could deliver strong annual returns. But the crucial distinction is that Microsoft's growth path appears clearer to analysts. Its drivers are visible and already monetizing. Apple's future growth relies more heavily on launching new hit products and breaking into unproven categories. Microsoft's aggressive push into AI and cloud gives it a more probable runway for outsized growth. Valuation reality check. Let's revisit that P/E ratio. Some will say, Apple is cheaper at 35 times earnings, so it's the better buy. This is a classic rookie mistake. You must always pair valuation with growth. A P/E of 35 on mid-single-digit revenue growth gives you a price-to-earnings growth, P/E ratio, of around 4 or higher. For Microsoft, a P/E of 37 paired with 15% growth gives a PEG ratio closer to 2.5. By this metric, Microsoft is actually the better bargain, despite its higher headline P/E. A higher multiple for a faster-growing company is often perfectly rational. If this is helping you understand these two giants better, hit that like button. It tells the algorithm this is valuable content and helps other investors see this crucial analysis. Dividend and buyback angle. Neither stock is a traditional income play. However, both are machines at returning cash to shareholders. Apple buys back about 3% of its shares annually, while Microsoft retires about 2%. Combined with their small dividends, Apple's total shareholder yield is around 3.5%, while Microsoft's is about 2.7%. For those prioritizing immediate cash returns from distributions, Apple has a slight edge, though the gap is slim. Tail risks. What about the risks that could throw a wrench in the works? For Apple, it's regulation. Europe's Digital Markets Act could force it to allow app sideloading, which would slash its lucrative App Store commission rates. That's a direct hit to a highly profitable segment. Microsoft constantly faces antitrust scrutiny. We saw it with the Activision acquisition, and bundling services is always a point of contention. A worst-case ruling could shave billions off either company's market cap overnight, but a key asymmetrical risk is China. Apple assembles the vast majority of its products there. A major geopolitical flare-up could cripple its production and sales. Microsoft's sales in mainland China are a much smaller portion of its total revenue. If global tensions spike, Apple has a far more direct and immediate vulnerability. Who should own what? The right choice depends on your goals, risk tolerance, and time horizon. If you're a growth investor who can stomach market volatility, Microsoft offers faster compounding potential and immediate AI optionality. You're betting on the future of enterprise software and the cloud. If you're more value-oriented and want brand stability, Apple's fortress-like balance sheet, unparalleled brand, and consistent buybacks fit the bill. It's a lower beta play, meaning it tends to be less volatile. For a retiree, neither dividend is enough to live on. You'd need to sell shares for income. In that case, Apple's lower volatility might make it a slightly more stable choice for planning periodic share sales. The arguments have been laid out. Now it's your turn. Comment below with your allocation, 100% MSFT, 100% AAPL, or a split. The best insights often come from the community, so let's get a conversation going. Final verdict. Both companies are world-class titans. You likely won't go wrong owning either over the very long term. But the goal is to determine which one offers more potential over the next 5 years. When you dissect the numbers, the business models, the moats, and especially the immediate AI opportunity, the scales tip. The data says Microsoft is the horse to ride. If you don't need current income, can accept market volatility, and are seeking aggressive growth, its growth drivers are clearer, its AI monetization is happening now, and its revenue is more predictable. Apple remains a stellar fortress for lower beta exposure, but for maximum richness potential in the coming years, the subscription empire wins. Thanks for watching. If this saved you hours of research, share it with a friend and hit that subscribe button. Until next time, invest wisely.